What do you think I did? I quit school immediately and just started buying apartments. Ultimately, immediately within that year, I bought a half vacant medical building, I bought an industrial building, and I bought two. With commercial real estate, there's a lot of upfront work when you buy a value add. You got to figure out what your business plan is, what capital improvements. As long as we were focused on multiple avenues of leasing and construction crew, we could typically turn these assets around fairly quickly. But then after that, once stabilized, management falls off by 90%.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm super excited for today's guest. We have Danny Newberry. He's a commercial real estate investor and the founder of Vail Commercial Group. I'm super excited because I've heard, we're obviously in Commercial Academy, Danny's in Commercial Academy, and everybody in that group looks up to Danny a tremendous amount. Everybody we talk to, somehow your name gets brought up and they're just like, this guy's a beast. He's an animal. So I'm super excited to have you on the podcast and just, learn from you.
Hey, thanks so much for having me on, guys. I really appreciate it. Looking forward to the conversation.
For sure. Well, I assume you're in Colorado, correct?
So I actually made a transition last year, and we bought a house in southern Utah. So we're doing winters in the high desert of southern Utah and summers in the high Rockies of Colorado.
Oh, cool, awesome. So you get quite the contrast. And you're pretty outdoorsy, and you like kind of outdoor adventure activities, right?
That's definitely high on my priority list. I'm a big adventure guy, so love climbing big mountains, love pretty much anything that's outdoor related, rock climbing, mountain biking, fly fishing, dirt biking, you name it, I like to do it. So
that's awesome. Yeah, I'm the same way. I love all that stuff. So I think it's cool to see, I follow you on Instagram and stuff and see some of the adventures and stuff you guys go on. And obviously that's possible through your success in commercial real estate. So I'm super excited.
Yes, sir.
So for people who don't know much about you, give us a little bit of background, how you got into commercial real estate.
Yeah, definitely. So, kind of going back to, my beginnings, high school, I was kind of a, entrepreneur. I was trying to figure it out. I was starting little side businesses, trying to make a couple bucks. So I had a candy vending machine business that I had, placed a bunch of units around town, and ultimately sold out of that and started doing some kitten smuggling, which, that was a lot of fun and very profitable, but only lasted so long. So I had to get serious and figure out what my next venture was. And ultimately, I read some real estate books, and I remember it was my first year of college, read Rich Dad, Poor Dad. I'm like, wow, this makes a ton of sense. And I want to, I'd like to try this out. So I remember that summer, I got a coach. I ended up putting a vacant 6-unit apartment complex under contract for $155,000 in my backyard. It was bank owned, and I didn't know where I was going to get the money. So I started talking to some hard money lenders, and luckily enough, my best friend's dad was a hard money lender. So I went to him, and at first he was like, hey, I'd rather just give you a wholesale fee and, you flip this to me. I really like it. I go, no, I really want to do it myself. And he goes, all right, I'll tell you what, I'll lend you the 155 plus another 30,000 to fix it up because it was vacant. And I'll do, like a year note. And so I ended up closing the transaction, and over that summer I fixed it up, filled it up, and it reappraised for $330,000. And I was like, whoa, this is nuts. I mean, I just created more equity in my first deal over a summer than a degree I didn't have, and to make less money than I would have if I would have kept going to college and getting that degree. So what do you think I did? I quit school immediately and just started buying apartments, small apartments all over southern Utah, and then ultimately decided, let's go to a big market, and ended up moving to Las Vegas, and we bought a bunch of apartments down there and transitioned from all these smaller apartments and realized, man, it's a management headache and nightmare to try and manage a ton of these, Class C apartments all over the place. And some of them were more like Class War Zone. But anyways, I decided, all right, it's time to scale up. So I started buying some bigger stuff. I got into a 48 unit and then 138 unit. And I remember one day, one of my investors, he was a family friend. He owned a sizable portfolio of commercial but all triple net leases. So mostly retail and industrial assets, some office. And I asked him one day, I said, why don't you own any apartments and you invest with me for the apartment side? He goes, oh, I don't want to work that hard. And I go, what do you mean? He goes, yeah, I've been there, done that. And he goes, I like the long-term triple net lease deals for my own portfolio because, he enjoyed a lot more freedom. And I go, wow, I got to figure this out. What's he talking about? So anyways, I ended up finding a mastermind group, which we're part of, right? And everyone in that group was primarily focused on, true triple net type deals. So retail, office, industrial, and then some other asset classes on top of that. But ultimately, immediately within that year, I bought a half vacant medical building. I bought an industrial building, and I bought 2 shopping centers, all in, I think that was Colorado, Wyoming. And immediately after signing my first lease on that medical office building, we created over $1 million in equity. And I was just like, this is incredible. And not only that, but my tenant's paying for all the common area maintenance, taxes, and insurance. And now I've got a long-term lease. What do I do now? And I'm like, wow, I just got my time back. So I was like, this is awesome. And ever since then, I literally have just focused on true commercial real estate, and primarily retail and industrial around the country. So
that's incredible. That's insane. If you dropped out of college and you were doing all that pretty much immediately, how old were you doing all these deals? Like, you must have been really, really young, because I know people talk about how young you are now, but
yeah, I was very lucky for sure. 19 when I bought my 18, I bought my first deal. 19 when I bought that apartment building. So
holy cow. That's awesome.
So it worked out well. And obviously got to ride, the wave all the way to the top. And the market has been a huge factor of all that. But I think that, within our group, we learn lessons, we learn, where each market is in its current state. And, I've been able to invest in over 18 markets, 18 states, but only through partnerships and, really getting inside intel with local investors. And I wouldn't have been able to do that without, the network and the group that we have, right? So that's a huge factor.
That is huge. That was actually going to be the next question I asked, because, you jumped right into commercial real estate, and just took off with it. And then you were like, yeah, I bought one here and there and there. And I was like, holy cow, you bought, all over the country. How were you able to manage that? So the answer to that is mostly just like leveraging good operators. Or were you involved in the operations and just investing capital, or was it kind of a split of both?
No, I was actually involved in pretty much all of it. I didn't have kids back then either. So I was a lot more flexible. I traveled a lot. But I think, the big thing is that with commercial real estate, there's a lot of upfront work when you buy a value add. So all the work on that asset is really, you get in there, you got to figure out what your business plan is. What capital improvements, what do I need to fill? How much, TI am I planning on putting into these units? And then you effectively, you just hit the ground running. When you close, it's go time. And so my goal was always to stabilize an asset in, typically 12 to 18 months. I didn't want it to be longer than that. As long as we were focused on multiple, avenues of leasing and had a lot of, a good construction crew, we could typically turn these assets around fairly quickly. But then after that, once it's stabilized, again, the management falls off by 90%. There's just not much to do other than collect checks. And, typically you'll have some boots on the ground, whether that be through a partnership with a local operator, or even just one of your tenants, or you can even hire a security service where they come once a week. They take a video, they give you an update. There's a lot of different ways to do it, camera systems. And so we've kind of tried it all. And actually every deal is a little different. There might be something that's already in place and it makes it way more easy. But for the most part, management, we do all in-house. Over $100 million in assets that we manage. And honestly, it's not that difficult. Now, if I were in apartments, that'd be a whole different scene. You're managing teams of people on site. You've got tons of turnover, tons of a vacancy that comes up on a regular basis that you're having to turn, and you're having to be very strategic on your expenses, and it's really easy to blow out, your cash flow projections if too many vacancies come up, and there's too much, there's quite a bit of your turnover costs. I remember a lot of that being an issue with where I was at with apartments was, it's just, man, you get more vacancies than you thought, or turnover than you thought in a given quarter. And, that just killed your cash flow for the year. So anyways, that was kind of again, I wasn't investing in class A. I was more class C, class D type properties when it came to the multifamily stuff. But, I don't think I'd go back to those days again. If I were to get back into multifamily, I'd focus on much higher quality assets.
For sure.
So you mentioned that you were under contract and bought an industrial building, a retail building, and a medical building. I think you said you bought a half vacant medical office building. Was the play just you knew that there was lots of value to be added? Like, how were you able to take all those different assets down at the same time, where it's kind of a big transition from multifamily? But
yeah,
a lot of people talk about the focus too. So I'm just kind of curious if it was partnerships or what was your methodology there?
Well, all those I did with I had one partner, and we were doing everything together. And so we just bought these deals. We kind of went on a buying spree very quickly. And anyways, so here's what I did. I bought a trailer and I'd literally just pack up my trailer and move on site. And, I'd be there as long as I needed to be. And then the nice thing was, like, I was kind of buying in, I at that time lived in Utah, and I could easily travel to Colorado, Wyoming, Arizona, Vegas. Like, it was like a circle for me. So a lot of my trips, and I was always into like outdoor adventure. So I'd kind of plan a fun trip around all my assets. And so I'd be constantly going in this circle, visiting a property for a week or two, and then moving on to the next place. And then in between, I'm, having all kinds of fun and doing my hikes and outdoor adventure stuff. And so it kind of really fit the mold at that time in my life.
That's sick.
Pretty cool.
So when you're going around visiting these things, are you talking about when you were going to look and see if you're going to acquire them, or were you just going to do like maintenance checkups, like management checkups?
Both. I mean, if I had a deal under contract in Idaho, I'd be like, okay, you know what? I'm going to go to Idaho, but then I'm going to circle around and I'm going to come down through Wyoming and check on these assets. And then I'm going to go to Colorado, and I'd make these trips a month long, or longer. I mean, it's just, I was kind of like, I had the freedom of being able to be very nimble and go wherever and be wherever I needed to be, because I wasn't bound to an office. I didn't have employees at the time. Other than one, I had one employee, and anyways, it just, that was my beginnings. Today, it's a much different look of how I do things. I don't travel nearly as much. I've got a family, so that's, I really, I just don't travel as much anymore. I basically have, other people that I partner with that I trust, and, they'll go be boots on the ground. They're the ones doing what I used to do. One of my mentors within the group that we're in, he always said, hey, your next step is to find 5 Dannies. And I go, what do you mean? He goes, that's how you're going to evolve, is you got to go help 5 people, achieve their goals and dreams, but they're going to be the ones that are hustling and boots on the ground and have the motivation to do what you're currently doing. And, I scratched my head with that for a couple of years, and I'm like, yeah, so that's what I've been doing. I've been doing a ton of partnerships with guys that are just getting going, that find a great deal, but don't have all the resources, capital, or wherewithal to take it down and take it from A to Z. And so I'm doing a ton of that these days.
That's awesome. Yeah, that's incredible. I mean, that's kind of like, I think I was telling you before we recorded, we started this podcast a little over a year ago, and we had no properties at the time. Fortunately, we work with City Plat, and so we've been able to learn from people like Nikita, and then also going to Commercial Academy and stuff. But we've bought 3 buildings between Jesse and I. We're under contract on our 4th, and then we bought 4 with City Plat, and we're about to have a 5th with them. So when hopefully all this is said and done, we'll have about 9 buildings, all industrial real estate. And that was over the course of about a year and a half-ish. But something we've seen like we're running into is like all these properties are in the same market, which I'm not complaining about at all. But some of the ones we picked up, I feel like are definitely like lower quality assets. And going into 2026, we're trying to figure out, one, how do we scale? And then 2, like what kind of properties do we want to keep buying the same type of stuff, or do we want to try to like level up maybe the location and the quality of the asset Because it seems like, as I listen to people like you and other people, in the beginning you got to buy deals and sell them and do what you can. But the really successful people seem to focus all their energy and effort on like really, really good deals. And it might be just one deal they did that year, but it's like a really good deal. I don't know. What are your thoughts on all that?
No, I totally agree. I mean, and it depends on the market cycle and where we're at with things. Sometimes it's buy season, right? And you got to get out there and just buy as much as you can because everything's on sale. And then the market shifts and then there's not as many good deals. And it's a great time to either liquidate or just cash flow your assets and be very picky and choosy. So, I would say that I'm really happy that I've done a lot of deals in a lot of areas and a lot of different asset classes, only because that now gives me the tools in my tool belt that when I see a great value add deal in different parts of the country and in different asset classes, I can take advantage of that. And I'm not pigeonholed to one asset class in one area. So I really like that because it just makes me a lot more open and susceptible to a lot more opportunities, right? And I can be more picky and choosy. But at the same time, becoming the absolute best at your market and in a single asset class is it's great. It's really great to have that as well, right? I mean, you can be very strategic. You can build, a portfolio for the long term. You know your market better than anybody. So you can probably manage better than anybody. You're going to have a lot more local insights than anybody. So there's a lot of strategic pieces to that. And I think that it gives you an advantage within that market.
Yeah, that's
I think
good.
those
So
are great points. Sorry, go ahead, Grant.
yeah, no, you're good. I was just thinking. So like, how do you, I guess my question would be like, anybody can go on CoStar or Crexi or whatever it may be, but how do you determine when something's a good deal? Because I feel like sometimes when you're looking at another market that you know nothing about, you might see it and be like, oh, this is a great price per foot, but there could be hidden things you're not aware of. Or is it really just that simple where you're like, okay, there's a great price per foot. I'm looking around the market. I see what things are leasing for. I know I can fill it at this rate. And with those things, I'm comfortable going in and buying it. Or is it just, that you have somebody that you know in that area who you trust's opinion of the location and all of that?
So here's what I'll say. I've gone to 18 different states and I've had, better luck in other places than others. And I've noticed, like some areas I get into, I'm like, wow, I didn't realize this or that. Right. And so now I'm not trying to buy all over the country. I'm trying to focus where I have the deepest roots, where I really understand the markets. And so for me, that is primarily the Southwest and Rocky Mountain region in Texas. So I'm really kind of focused on this circle between, Colorado, Wyoming, Montana, Idaho, Utah, Nevada, Arizona, New Mexico. Like that circle right there, I feel like really comfortable, really easy for me to get to. I've done deals in all these markets. I've built teams within these markets, and it's where I'm putting a majority of my time, tension, and focus. But I would say that I will look at other stuff elsewhere, but it's got to be a very strategic partnership with somebody that I trust. I know they know the market better than me, better than anybody, and I feel very confident in their, in their analysis. So yeah, that's kind of the way I'm looking at new markets and territories. Is I don't want to go in there myself and have to learn the hard way, yeah, I think it's still okay to do deals outside of your target markets if you've got the right team put together.
Yeah. I feel like I just get caught up in like, I go back and forth where I'm like, we need to just focus in one area and find deals and be the best at finding deals in this area. And then the other side of me is like, well, there's properties here and there. And like this person's buying it over there. It's like, you can get, shiny object syndrome pretty quickly and trying to find deals. And it's like, you can only focus so much. So just trying to find a balance of that is hard for sure.
Yeah, no, I totally agree. And I think that another piece of it is like, hey, you guys are doing industrial, right? So you at least understand that asset class. Maybe you don't understand the fundamentals of different markets, but you understand how to underwrite industrial. So you could go to any market and you can be like, all right, this looks interesting. It fits within the stuff that I'm buying. So I understand that asset class. Now let's look at the market. Okay, you could go on CoStar and LoopNet and see what the lease rates are, seeing what the vacancy rate is, and then you can say, well, look, I'm buying this thing for sub $100 a foot, $5 rents in place, but I know the market's $12 in place based on this quick analysis. this is super interesting. Now, I don't know all the other dynamics of the market, and that's where, hey, do you know somebody in that market? Or, if you called the top 10 brokers in that market, how much are you going to learn? Probably a lot. You're going to figure out real quick if there's a story behind it. And then you're like, hey, I actually like everything I'm hearing. So at that point, you put the deal under contract and then you go on site, right? You go to the market, you drive the neighborhoods, you talk to the local leasing brokers, you talk to all your tenants, you really figure out what is the story behind this? Is it truly a value add in what I thought it was, or is there a bigger picture that I wasn't seeing? And now that I'm here, it's starting to unfold, and maybe I don't like the story, or maybe you really do like the story, and that there's a way to really turn this thing around. So I think there's ways to do that outside of your market without necessarily committing to the deal without really feeling comfortable.
Yeah, that makes a lot of sense. Question I was going to ask was, when you're teaching these 5 Dannies that you were talking about, are you telling them to focus in one market, or are you telling them to focus on 2 to 3 markets?
No, I mean, just in our markets that we're in, so primarily like kind of our all the states I mentioned, right? Like, hey, this is where we should be focusing in these primarily 2 asset classes that we are wanting to dominate in, which is neighborhood shopping centers and small bay industrial or multi-tenant industrial, right? So that's kind of our bread and butter. And, it's a couple different things that we're focused on. We're looking at price per foot. We're looking at lease rates. We want to make sure that, hey, we're buying below replacement cost. We are buying with vacancy and or way below market rate rents. And, if there's deferred maintenance, it looks like, the landlord hasn't been reinvesting into the asset. We love that. And one of the biggest things that we find on the deals that we tend to do a lot more of is it's typically owners that are over like 60 years old, right? They're into retirement, they're traveling a lot, or they, aren't managing the way that they used to because they're spending more time with friends, family, and their lives. And so the asset is kind of put on the back burner, right? And so that's where we tend to find a lot of value and make great deals with owners. And a lot of times there's seller financing or creative structures in place. And so that seems to be where we excel the most with the type of offers that we make and the deals that we buy.
Yeah, that's what I've heard. That you're really, really good at seller financing. You're really good at building rapport with owners, and then that's that allows you and helps you get those types of deals. So, like, walk us through some of your core strategies on how to get like a good seller financing deal. I know a lot of it is circumstantial, like you said, where it's the owner who's older, maybe they're retiring. But do you have any other what's kind of your standard operating procedure for going about trying to get a seller financing deal?
Yeah, so really it's figuring out their situation and their motivation, right? I mean, that's kind of obvious. You want to know where they are, how much debt do they have, what is their lifestyle look like, how old are they, what are they doing, right? So that kind of, a lot of times you can really figure out, okay, wait, they need cash, they have, medical problems that are, arising, or, something happened in the family, or they just, whatever the case may be. Or they might be like, you see, hey, they're traveling. They're focused more on monthly cash flow and consistent distributions, right? So, okay, wait, that really aligns with what I'm looking for. Now let's figure out what gets them comfortable with me, with buying their asset and staying in the deal, and so then you start talking about, what that looks like, and really building upon that. So that could be like, hey, look, you want $2 million? I'd really love to pay you that, but I really can only get to 1.5 in evaluation, and maybe you're off on that price, but at least start to let them know exactly where you are and why you're there, and do it in a very nice and, methodical way, where if they say no, that you can just continue building that rapport with them, because eventually it's going to be a yes. And, some of these relationships can take months, if not years, to cultivate to the point to where you just catch them on the right day, or it's just the right time, or they realize, yeah, they are actually right in their evaluation, and that's a fair market offer, and it's time to pull the trigger on that. Right. So it's just, being consistent, follow up. I mean, I think that's the big one. I just see so many people have a conversation with the seller 1 or 2 or 3 times over a course of a month or 2, and then it didn't work out. They didn't come to terms. They were too far apart, and then they never followed up with that person. It's like, well, actually, that's your best lead that you have, because now they know who you are. You're going to be their first call when they're ready to sell. And if you're following up and you're building rapport and you're creating a relationship, they're going to remember that. And so I feel like so many of my greatest deals have been with the follow up.
Yeah. That's a great point too, and especially with seller financing, because it's just so rare that you're going to call somebody that they're going to be ready to sell in the first one or two calls that you make with them and give you a seller finance deal.
Absolutely. Yep.
And especially with these guys that own the assets forever, and you're calling them out of the blue, they're probably not ready to sell yet, and it may be a year or two or more before. We were working on a deal just this week, and like, look, the numbers just doesn't make sense. We hesitated on sending an offer, but it's interesting what you're saying is still send the offer over, explain to them why you are putting an offer at this number, and if it doesn't work, it doesn't work, and you don't sweat about trying to insult them. I think that's what we're always scared of, is like trying to not insult them, but still put out the offer that we want. That's interesting. I haven't heard that. So I think that's definitely a great tool for people out there.
One thing you can do too to pay a little more, maybe get to their price. Okay, you want 2 million. I really feel comfortable at 1.5, but there's still some juice in the deal. Maybe you can get it to 2.5, 3 million at the end of the day. What you do is maybe you say, okay, look, I'm willing to come up to 2 million, but I want to do, a really great terms. Let me get in super light, or maybe you structure it in a sense where they become your equity partner, meaning you have them do preferred equity. So now, okay, I'm going to buy it for 2. My downstroke with the bank is going to be 600,000-700,000. You have them stay in as preferred equity for the 600 or 700, not as a second, but as a true LP, right? And you don't give up equity; you just give them an interest rate, a preferred return on that money. Maybe you give them a 5 or 10% upside, but you don't have to make it over the top. So that's one way to maybe bridge the gap if you're willing to pay more and you really love the asset and you believe in it. And that's a great opportunity too, because then you're getting into an asset with no money down, and you just bridge the gap, and now you can still cash flow it and you can still create some equity.
Yeah, that's an incredible option we haven't thought much about. I've heard people doing that, but we've never tried it. We've always just done seller financing. A strategy that, well, I have 2 questions. So earlier on, you said, depends on where you're at in the market cycle, whether or not it's buying, you're buying in buy mode, or if you're just in sit and cash out mode. Where are you at right now? Like, where do you think we are with the market cycle? Have you been buying a lot of opportunities, or you've been trying to sell some of them?
No, I actually had a big year of selling in 2025. I bought 3 or 4 deals. On average, we've bought 7 or 8 a year. But so yeah, we were down about half, but we did sell a lot. And this year, it's hard to say exactly, but we are going to put a lot more emphasis on acquisitions in our deal funnel and putting more resources towards it. I think you can buy great deals in any market, up, down, sideways. I really do. I feel like, how hard are you pushing, and are you just looking on where everyone else is looking, on LoopNet and CoStar, right? But if you're out there, and you've got lots of irons in the fire, I feel like that's what it takes to find great deals consistently. And so like for us, yes, we are looking for great deals. We're looking to, find more opportunities to close. And we're definitely sitting on some cash that, we'd like to deploy. So, at the end of the day, I mean, I'm just kind of always a buyer and always a seller. It's just, I would say I'm always doing both.
Okay. Well, that's awesome. Yeah, I've heard, it seems like a lot of people are like that. I mean, it's the most logical way to be. If you come across a great opportunity, what are you going to do? Say, no, I'm not in buying mode right now. It's like, no, you'll buy it. And if someone brings you a great offer, that's, maybe stupid offer, maybe someone's got a 1031 exchange, or maybe they're just inexperienced, you may as well cash in on it. A strategy we've heard a lot of people talk about is sending 2 offers, where you send one that's seller financing and then another that is cash. And then the seller financing one might be much closer to what they were asking. The cash might be much lower, and that kind of encourages them to take the seller financing. Do you have any other kind of tricks or things that you do like that?
Yeah, I mean, so again, that's a great one. Maybe you make a 3-part offer, and that one is where the seller comes in for your equity piece, and that's somewhere, in the middle or even towards what they want, and so it all depends on, again, how much upside is there, even from, okay, hey, you'd like to be at X price and they want to be here. Is there still upside from their price? And, is it enough to make it, attractive enough to you, right? And if it is, there's just, you can do the seller financing, you can do the pref equity, you could structure it in different ways like that. And it's really just figuring out what the seller's needs really are. But yeah, if I, a lot of times when sellers say, "Hey, I don't want to do anything creative and I just want my price all cash and this is my asking price." Well, that's kind of a dead end. At that point in time, that's a dead end right then, not maybe in 3, 6, 12 months, but at that point in time, it's like, okay, well, it doesn't work, right? We're too far apart. But hey, Mr. Seller, like, if you change your mind, please think of me. Do you mind if I follow up with you in a couple months and just, see how everything's going, see if anything's changed, shifted, whatever. And they always say, yeah, no problem. And so then in a few months you give them a call and, hey, how's everything going? And blah, blah, blah. Oh, you lost a tenant. Oh, this or whatever, it's like, hey, my offer still stands. I'm still very interested. I'd love to do a deal with you. Would you reconsider?
Yeah.
And you just keep opening it and leaving it open when that conversation's over, whether even if you come to a roadblock.
100%. Yeah, it's like going back to the point of what you're talking about, the money's in the follow-up. And I've heard it too say that I think it's like it normally takes 7 or 8 times following up for anything actually to happen. So that's a great point. Right now, you guys are, you said you're ramping up your acquisitions pipeline to try to buy some deals in 2026. What are kind of the primary ways that you guys find deals? We hear a lot of people talking about letters. Obviously, there's cold calling, and then you can look on the market as well. But what do you guys do typically?
Yeah, so text message marketing. We're doing email blasts. We're going to expired listings or listings that are coming up. So, like if you think about it, a lot of these listings that are up for sale, it's typically a 6-month listing with the broker. Well, if the property has been out to market for 5 months, that means the broker is really motivated because he's only got 30 days left, before their listing's up, and they probably aren't getting an extension because they haven't performed, right? So they're motivated to do a deal and convince the seller, like, hey, this is where market is. So we've been going after those type of properties that have been sitting for 4, 5, 6 months, and and so again, going back to having a lot of irons in the fire. We've done, we do mailers, we do cold calling, we have great broker relationships that we're following up on. We're scouring our emails when it says value add opportunity or REO. We're calling on those deals. We're doing, the text message marketing, the email blasts, and going after the expired stuff. So yeah, I mean, there's just so many different ways, but I think it's being consistent and looking at all your different avenues of what you can do. And not every one of those makes sense. Mailers haven't been working that great over the last year or two, I've noticed. So our hit rate hasn't been very high, and our actual conversion rate hasn't been as great as it was in the past. So, we're getting better with other things, and other things seem to be working better than others. So yeah, you're just constantly having to test different ways, but I think it's all about having as many opportunities coming to you from different avenues as possible.
How do you guys track? Like, how do you track all that stuff? Like when somebody calls in, and do you straight up ask them?
Yeah, we use a couple different platforms. So we have HubSpot, we have CallRail, we have there's like 1 or 2 more that I'm not thinking of right now. But yeah, we're able to track the number of calls that come in. Hey, how many letters went out? How many text messages went out? How many emails went out? Okay, here's we called 50 cold calls, and this is what we got. So it's all through the platforms that we're using.
That's interesting. Yeah, I think you said that consistency is like key, because you can do all this stuff. I mean, I feel like that's what we're kind of worst at. We cold call a lot, but it's definitely in spurts. Like we'll cold call, we'll find several deals, maybe we'll get one under contract, and we're brokers too. So like our day job is also looking for deals in the brokerage world. So we'll call, get deals under contract, get busy with that, and then be like, oh, we got to get back to calling. Same thing with the mailing. We'll send out a bunch of mailers, and then so being consistent across the board is definitely the best. And we were at a small bay flex boot camp back in September in California, and they were saying that small bay flex deals, the majority of them are going to be listed through a broker. So they were saying like a lot of what they found, like when they were finding these deals, like it was an overwhelming amount of them were coming from brokers, not necessarily listed, but just brokers in general, because they're kind of gatekeeping that versus just like direct to seller. I think it was like, I want to say it was like 80%. Do you remember, Jesse?
I don't remember it being that high. I thought it was like 60, 70, but I could be remembering it correctly.
Was that Allen and Saul's deal?
Yeah.
Yep. Allen and Saul's boot camp. Yep.
Got it. Yeah. Yeah. I mean, look, I've personally found a lot of small bay deals off market and not through brokers and direct to seller. But, I think that, brokers are a huge part of our business, and you should definitely have lots of brokers in your back pocket.
That's awesome. Yeah. So if you were to talk to somebody like either a beginner or even somebody like us, we have, between Jesse and I, we got 3 buildings. We're hopefully about to close our 4th. What would you recommend for us to do to scale? Because we want to get to the next level. We don't want to do too many at one time and sink what we have, but at the same time, we want to do bigger and better deals, or at least we just want to scale. So I'm curious what your thoughts would be.
I don't know if bigger is always better, personally. Sometimes it's a, pound your chest kind of thing, like, oh, I own this many square feet, or I've done this much in deals and whatever. I think it's just all about staying within your metric of finding very profitable deals, whether it's a small deal, a medium-sized deal, or a big deal. And a lot of these deals that we're finding are, 1 to 3 million. I mean, I've done $20 million deals, but I prefer a 1 to 3. It's easier. It's less headache, a lot less debt on your balance sheet. They can be sometimes just as profitable as the big stuff. So wouldn't necessarily say that. I would say that if you want to scale, it's really just consistency, right? So I remember when I only had a couple deals, and I was like, man, that would be so cool if I had, a couple $100 million in assets under management, or a couple million square feet, or whatever. What I realized is, wow, looking back, all it was is just staying consistent and doing, I was probably doing, like I said, around 7-8 deals a year. That's kind of a lot, but that adds up, right? After half a decade of doing that, you look back, you're like, whoa, that's a lot of improvement over those years. And it was just consistency. So even if you're just doing 1 a quarter or 2 a year, even in, 5 or 10 years, that's going to add up, and that's going to look great. And that's going to, your cash flow is going to see it. Your net worth is really going to show. And, I would say, again, consistency.
Yeah. That's awesome and encouraging too, because we've kind of said that. I think we're still trying to determine our goals for this year, but we even said it wasn't as much about the number of deals like you're saying, or the portfolio. We've never cared about portfolio value, but we have said, we want to buy this many deals. Our main thing, and this is probably everybody, but we want as little deals as possible with the most amount of cash flow as possible, because we want to do things like what you're talking about, travel around. I have a young family, so I want to spend more time with them, spend less time doing broker deals, but more, collecting cash flow, working on the business, trying to find opportunities for us, and hanging out with family. Yeah. So the cash flow is definitely, a big part of it. And I think that's maybe with the mindset of trying to do slightly bigger deals. Because when I say the deals we've done so far, everything has been under $1 million for the most part. So they've been little quote unquote deals. But
so, I would say that, what my strategy is, we, out of every 3 deals we buy, we sell 2 and keep 1. And, we're kind of recycling the cash. And then we're buying, we're owning the really the highest quality ones. We're holding. I think that's when I look back on my career, there's a bunch where I'm like, man, that was such a great asset. Why did I sell it? I wanted the cash at that moment in time, and it was helpful. But when I really look at it, if I would have held on, I mean, there's just some deals that you should never sell. They are, they're just a diamond. Yeah, they're a needle in a haystack. They produce consistently. You bought them at the right basis, and really it's just going to continue going up, and the area is going to continue getting better, and your cash flow is going to continue getting stronger, and you're going to continue paying down that debt, and so I would say, hold on to the ones that really are high quality, that really have more future upside, and sell the ones where it's kind of like you've really tapped it as far as it can go. And, maybe it's a little bit squirrely on the rent roll, or, the long term of the area and whatnot, and, get the cash and move on from those ones, right? And take that and roll them into higher quality ones.
For sure. It seems like that's kind of the internal struggle with commercial real estate investors.
Definitely.
Do you sell, Jared told us to sell in the beginning, which I think is true for a lot of times. And we're planning on selling our first deal to our tenant. But I'm curious, you mentioned, you talked a little bit about it, but what do you consider a high quality deal versus non-quality deal? Is it the tenant? Is it the terms? If you can get seller financing?
So I would say this is something one of my really good friends in commercial real estate said to me one time, because I asked the same question to him. When do you know when to buy versus sell? He goes, Danny, sometimes you think you're going to buy this deal and it's going to be great. And from day one, it just gives you problems. Just, you do everything right, but there's just always a headache. And he goes, you'll never know right away, but within a year or two, you typically will know, like, hey, this is a sell property. Like, you got it's you take 2 steps forward and 1 step back. And on the flip side, if you buy something and you turn on the cash flow from day one and it just keeps gushing every month consistently, very little management involved, and it just doesn't take a lot of your time, effort, or focus, so you can focus on other things. He goes, that's a pretty good one to maybe consider holding for the long term. So I can't really tell you specifically. That's more of a gut thing, and that's more of a philosophy type of a scenario. But yeah, I've noticed that some deals are just a real pain in the ass, and other deals are just, couldn't be easier.
Yeah, just in the couple we've bought, we've kind of seen that for sure. Where we got one building where they put us on auto draft, and so they pay us first of the month every time, like no questions. Haven't heard from them since, which is sick. Then we've got another one where we're literally fighting tooth and nail to get the guy to pay rent. I mean, he does, but he just does it late. So it's like,
there's your answer.
Yeah. Yeah, 100%. That's interesting. So one of the questions I was going to ask you is, and I'm sure this varies like most people, but for the most part, are you guys raising, like if you're buying $1 to $3 million deals, are you raising from outside investors, or are you just getting it from, friends that you've made through commercial real estate, or is it recycled capital?
So at this point, it's recycled capital on all the smaller stuff. We are still doing some syndications when we do the larger acquisitions. So yeah, it's a mix, but I would say the majority of our deals we're trying to do internally.
That's what I figured. That's awesome. Yeah, that's another thing about scaling too, is like we go back and forth between, bringing in more people or just trying to bootstrap these littler deals in the beginning and sell a couple and then take that equity and go into the next one and just own more of the ownership.
Yeah, for me, it's been easier. So what I've noticed personally is that I'm not in love with big syndications where, I bring in 20, 30 investors on a deal. But I do have a couple really great relationships with investors where if I call them, I'm only doing the deal with them. And it doesn't feel like, it's not really a syndication. It's really more of just a partnership, but I'm doing all the work and everything. And I really like that structure. So finding just 1 or 2 guys that you can consistently do deals with, so it doesn't slow you down from doing deals, but at the same time, you're not out there having to call up 50 people to raise 50 to 100,000 a pop to, raise a couple $1,000,000. Like that's just, to me, I don't think the brain damage is worth it that often.
Yeah,
we say Graham says that simplicity is key. That's like one of our core values between us. Like, if we can keep it as simple as possible, partnership is way more simple than what you mentioned, 50 investors. It's just, we've already seen it from other people that like you mentioned, brain damage is just not worth it.
Yeah.
And we'd rather have fewer people in the deal who we actually like enjoy working with and enjoy doing business, because we're not out here trying to build a $500 million portfolio. Like, if it ever gets to that point, that'd be awesome. That'd be sick. But our main intent is like more so like what you have going on. I mean, you guys probably have clips that, but what I mean is like in sense of the lifestyle. Like, yeah, you seem like you have an awesome lifestyle where you're doing a lot of cool adventure stuff. You're spending time with your family. You're doing commercial real estate deals, and that's definitely appealing. Like, we're not afraid of working. We love working. I love buying commercial real estate and running. I love all this stuff. It's amazing. But I'm not interested in doing a big syndication where I got to answer to 50 different investors and do all this paperwork and stuff like that. It doesn't sound very fun to me.
I mean, some people love it, but
yeah, for sure,
it's definitely not my forte.
For sure. So, are you guys looking at all asset classes right now, or you have one you're focusing on, or do you like most right now, or are you kind of just opportunistic?
Man, I primarily retail and industrial. I mean, that's where we put, 80, 90% of our attention and focus and our actual buy box. But we will look at anything that makes sense. We just did a deal out in Whitefish, Montana, a couple condos, and we just sold out of it actually like 2 months ago and did really well. And, we bought a land deal we're doing a development on for manufacturing warehousing. We are looking at some office assets and some medical assets. No, it's not it's if it's beyond retail and industrial, it's just got to be an absolute home run. Like it's got to, if it doesn't pencil on the back of a napkin, I'm not interested. If it's too hard to explain and, there's a ton of moving parts, probably not doing it. But, if it's just like, wow, okay, you found something, this is a no brainer. Yeah, we can figure it out.
That's awesome. It seems like almost everybody in the Commercial Academy group, like that's the two things they're buying, retail and industrial. I mean, there's a couple of exceptions who are buying, multifamily and office and stuff like that, but it seems like it's definitely the most popular asset class. I'm curious, do you see that across like other people outside of that group? Because I feel like I didn't hear about those two specific going together so often until I got into the group. But outside of it, I was just going to say, outside of it, you see people buying like multi and stuff.
That's the whole reason I've been part of the group for so long. It's been a decade. And the reason is because there's a lot of masterminds out there, a lot of groups that, focus on, residential, focus on multifamily, land development, but you don't really see true commercial. There's not a lot of masterminds or groups that truly focus on that. And so this has been one that, that's kind of the core focus, right? And that's how it was built. And so, yeah, at the end of the day, I haven't seen a lot of other groups that primarily focus in that space.
Yeah. Well, this has been awesome. We don't want to take too much of your time. I'm sure you're super busy. But if people want to reach out to you and find out more, more about what you guys got going on, what would be the best place to do it?
ValeCommercialGroup.com. People can also email me direct, newberrydanny@gmail.com. And, happy to connect, happy to, partner up, joint venture on deals. Love doing that, GPing on deals. I'm not really an LP, so I wouldn't say that. I'm not really interested in coming in on a deal for, $100,000 and being an LP and completely passive. Just guess I'm too young for that. But anyways, I would definitely, have interest in partnerships.
Okay. Awesome. That's awesome. Well, thank you so much again. This has been incredible. If you guys are listening to this, definitely reach out to Danny if you have any questions or want to do any kind of deals with him or have stuff out that way. And we will see you guys in the next one.
Hey, thanks so much, guys. Really appreciate it.
Yeah.
Thank you, Danny.